Hello and welcome to Module 6. Very happy to be here and to take you guys through almost the end of this series that we've created for you. And I feel that today's topic is something which most of you are looking for, to understand what fundraising looks like, to actually raise funds for your startup idea. There are going to be a few things which I might tell you today which will disappoint you. Again, fundraising as a topic is quite vast, which is why we have divided it into two modules. So today we are going to understand the basics, the 101 part, and the last module again is going to be around fundraising, where you understand and we go deeper into fundraising. I do understand this is probably one of the most important things, which is why we have two modules on this. So just to give you a quick overview, before fundraising, we all obviously need to register our companies. So we are just quickly going to understand what registration looks like, the different kinds of options that are available to you, and then move on to fundraising options, how you can finance your business. Then we're going to understand what different incubators, accelerators help you with, what are the grants that are available. Finally, end with DPIIT and Startup India as options for you to fundraise. So there are obviously a lot of different types of companies that you can choose to. Please understand that you need to have a company registered if you are going for any kind of fundraising. Now, in India, there are multiple options, but there are, if I had to talk about 5 main options that you obviously have the sole proprietorship, which anyone can start being the only founder. Then you have a partnership firm. Then there is a limited liability partnership. Fourth is the private limited company, and the fifth is one-person company. Cool. So there are some pros and some cons of setting up each of these businesses, types of businesses. If you are looking to raise funds, you have to have a limited liability company partnership or a private limited minimum to get funds. For grants, you can apply with a LLP, but if you are going towards professional investors, you should be looking at a private limited company at this point of time. Now, there are pros and cons, as I said, of each type of companies. So if you look at ease of setup, sole proprietorship and partnership firms are very easy to set up. LLPs and private limited companies require a little more documentation, and so does a one-person company. For a sole proprietorship, the compliance cost is quite low. For a partnership firm and a limited liability partnership, again, the compliance cost increases, but it's not too much. For any kind of a company, whether it's a private limited or a one-person company, the compliance cost is quite high. It does make sense to have a LLP if you do have a fundraising objective going forward, because the shifting cost from a LLP to a private limited later is quite high, not just in terms of money, but also in terms of the amount and the compliance that you have to do, amount of time that you spend and the compliance that you have to do later on. Basically, a lot of registrations, changing your bank account details, GST numbers, all of those things will also be needed to be updated. In terms of DPIIT, sole proprietorships cannot be registered under DPIIT, which means you will not be eligible for Startup India grants as well. Partnership firms, if they are a registered partnership, they can be used to apply for DPIIT. And LLPs, private limiteds, and one-person companies obviously are qualified for DPIIT as they are eligible for that. Sole proprietorships are usually ideal for freelancers or very small businesses, one-person businesses. Partnerships if you want to scale a business with a co-founder. LLPs if you're looking uh, for professionals who are looking to set up businesses that can raise money and get grants. Private limited, once you start seeking private investments, obviously you should have a private limited company. And for solopreneurs who want to again raise investments uh, from professional investors, you can set up OPCs. So that's a very basic understanding. I'm sure most of you already had that understanding, but this was just for those who are still looking to register their companies. If you are very serious about building your business, if you have some validation, I suggest you register your company as soon as possible. There are a lot of CAs that can help you out with that. And you should register your company if you're looking at fundraising, because the revenue, etc., that you start making should come into the company bank account, because that would be used for due diligence when your investors are asking you for compliance, etc. Once your pitch decks and all those things have gone through, your deals you have term sheets, there is a thing called due diligence that happens. During that, you'll have to submit your bank account statements, and you will have to submit your company bank account statements then. Okay, so let's move on to fundraising. Now, I have personally bootstrapped all of my companies. Bootstrap means using your own personal savings or using the revenue that the business generates and limiting any kind of external investment into your business. I feel it's one of the best ways to grow a business. Now, I do understand for some industries, it is absolutely impossible. Even if you ask me today, if I had to scale a D2C brand today, it would be very tough. When I started my D2C brand, the word D2C1 did not exist. There were no playbooks. The customer acquisition costs were very low. We had a great profit making idea. So things were much different as compared to the environment today. If you do not have deep pockets or personal savings that you can put in, bootstrapping would be tough. Again, for businesses that have a longer gestation period, as in from the time that they launch their product to the time that the company starts making money is long, then bootstrapping becomes tough. But if you can immediately start making some kind of revenue and you can start reinvesting that revenue, it's a great way to start. Every option has pros and cons. So if we talk about bootstrapping, one, it gives you a lot of independence. You are the one responsible for the direction of the company. There is no one else that you are answerable to, which again gives you a lot of flexibility. Maybe you want to exit. See, when we talk about exits, one thing that you need to understand is that when you go into the VC game, and I call it a game because once you're in it, there is no going back. For VCs, they will block exits for you as long as their objectives are not met. But for you as a founder, you probably don't need $1 billion exit. A $10 million or $100 million company changes your life and probably the generations to come after you. So having that kind of a flexibility with bootstrapping allows you to exit at your convenience, allows you to take growth at the rate that you want to, and not at the at someone else's. There's no gun to your head basically to grow your company at the speed that someone else expects from you. You can grow sustainably, you can grow organically, and you can create a strong business with a strong foundation. Again, since you do not take any external debts, there are no loans, there are no reservicing that you need to do. So that kind of reduces your risk. Now, in terms of cons, your growth rate will be limited. Now, even let's say if you reach a 1 crore rupee revenue run rate, how much profit are you making on that? 10, 15, 20 lakh rupees? And you are just reinvesting that 10, 20, 15 lakh rupees. So if you really need to do blitz scaling and rapid growth, this kind of profit reinvestment might not be ideal for you. And also, since there is no external capital, you're not taking external funding, you are limited to the amount of money that you have. And once that runs out, the business has a risk of dying. So those are the two disadvantages. I still feel bootstrapping as a way to grow businesses is amazing. But again, it depends on your objectives and on your personal conditions. Next, we have the 3 Fs. I like to remove the third F. People usually call it friends, family, and fools. I don't think we should be calling anyone a fool if they are taking a bet on us. So I'd like to limit that word. I'd like to limit it to friends and family who believe in us, who believe that we are going to do something, and they are the ones who give us the initial capital. Again, a great way for you to take money from someone at an initial stage to set up their business. I've made a couple of investments in friends and family rounds, and these are only because I trust the people who are building those businesses, and I wanted to be a part of those journeys with them. Now, in terms of the pros, from an entrepreneur's perspective, again, there is still a little bit of lesser risk, right? Yes, you are putting your reputation on the line with the family members, but you are still not taking money from banks where you have collaterals and your house might end up going due to a business decision that you make. There could be flexible terms over here. There's more flexibility. You could return the money at a later date. Your friends and family are more likely to have that understanding and belief in you. You also get a little more operational flexibility. Again, here you are the one who can make the business decisions. You haven't given out enough equity that anyone else will be controlling your board or controlling your major decisions such as exits or who you want to take investments from, or any kind of pressure in terms of growing your company. In terms of cons, yes, there is the risk of ruining those personal relationships. If you feel that you've borrowed money and you're not able to return it back, the credibility does go down, and you might not be able to take those people into confidence ever again in the future. Again, it's a risk that they are taking, so it's good that you are upfront about the risks when you're taking money from friends and family, but there is this risk of reputation over there. You can't get too much money. If you really need 10 CR to grow your business, it's tough that you're going to get it from friends and family. And sometimes it also leads to lack of professionalism. Now imagine you've opened a restaurant and you've borrowed money from your uncle, and every weekend your uncle brings in his friends and family to your restaurant saying that this is almost his restaurant and does not end up paying the bills over there. So there is that lack of professionalism in this kind of a business, in this kind of a way to raise funding. Third is an option to raise money from bank loans. Again, this option is not available to everyone. You need to have a decent credit history to be able to take advantage of these kinds of loans. There is a simple rule. A lot of people are afraid to take bank loans, right? And I suggest taking bank loans once you have some kind of a proven business model, you have some kind of established revenue stream, and you have some kind of predictability over your revenues. Now, suppose you've run your business for a couple of years and you realize that you've constantly hit a 20% net margin, profit after tax. The rule of thumb over here is that if you are able to get a loan at a 10% interest rate, you should have a net margin of 20% or more. So that means if it's more than 2x, right? If the loan percentage is 15, you need to maintain a 30% or more net margin. If the loan is 5%, you need to maintain 10% or more of net margin. If you're meeting this criteria consistently over 2 or 3 years, you can start exploring this option as a way to grow your business without taking any external funding that dilutes your company, in which you do not give out any kind of equity or control. So bank loans are a great way for more mature businesses to grow grow their revenues, grow their businesses. As I said, it's great to add leverage. Leverage basically means that you're growing without giving out any kind of equity. And there are always prepayment options with these loans. If you make a surplus amount of money, you can prepay your loans, and it does involve usually some amount of extra fees, but it saves you interest payments over a longer period of time. The cons in this case would be that a lot of times your loans are secured against assets, against collaterals. So that could be a big risk. There could be high rates of interest, especially for new businesses. The business loans are quite high in terms of interest rates, and that does eat up into your margin. But if you have no other option, then this again is something that you have to take. And again, considering it is a professional relationship, there is lack of flexibility. You have to make your repayments on time, otherwise the interest just compounds and you could end up in a debt trap. Okay, now we move to more professional category of investments, and the number one in that is angel investors. You might have heard, it's become a very common practice for high net and ultra high net individuals who've made money either through startups or through their careers or through some other businesses, allocating a portion of their portfolios towards startups. Not a lot, but usually these people allocate about 4 to 5% of their portfolios to startups, to risky assets. They understand the risks involved. A lot of times these people are industry veterans and they invest money for equity. They take a part of your business. The pros in this case are that these people invest at an early stage. A lot of them also invest at idea stages where they back exceptional founders. They bring in expertise and network that can really add value to your business. And this is again something that you should be looking out for. When you are raising money, look for smart investors. And when I say smart, it means that they are bringing in more than just money. Yes, they are investing in your company for an equity stake, but now they are equally involved in the growth of your company. Your objectives are aligned, so they open up their network. They bring in more suppliers. They bring in more sales deals for you. They refer amazing talent for you to hire. So these are again some amazing people to have on your team if you're looking for early stage fundraising. And again, they do offer flexible terms. A lot of them are opening up to the idea of convertible notes and safes as well at an early stage. The problem with this kind of a investment is, for a lot of angels, even though they do call themselves angels, the amount of money that each angel commits is going to be comparatively smaller, right? So in some cases, it could be as small as 5 lakh rupees for a ticket size, or a maximum it could be 50 lakhs to 1 CR that they're going to bring in. If you need more money than that, you will have to have a pool of investors that you bring together, right? You have to have a lot of angel investors that you bring in together. It leads to dilution. Pre-revenue at an idea stage, yes, you can get the convertible notes, but beyond that, if you are still working with angel investors, they will put a value to the investment, and usually there is going to be about 15 to 20% of dilution. Again, this is a ballpark, could be more or less, but there is going to be that kind of a dilution that they are looking for at this stage. Valuation again could be tough because you do not have a lot of historical data when they come in, so a lot depends on the negotiation powers. As I said, they are again betting on the team. So if they do not like the team, they will not invest in the company despite having strong initial traction as well. So there is that kind of a personal rapport as well that you've got to create with them. Next is venture capitalists, or VCs as we call them. So VCs is nothing but a group of people that come together to invest. How does this work? Usually there is a general partner, the person who starts the fund, and they have a team. But that person does not have all the money that the VC fund has. They take LPs, which is limited partners or other people that contribute money together, and then they leave the decision making to the hands of the general partner to invest their money. This way, they do not have to be involved in finding deals, evaluating, doing due diligence, keeping a good pipeline, all those things, and they can just pass away these core core activities to the general partner who has a team of professionals who vets the deals, does the due diligence, finds the deals, talks to the founders, does background research, not just about the company, but of the industry, the market, understands trends much better, and compiles all the money and invests on behalf of everyone. Now, you need to understand that considering this is a pool of money, almost like a mutual fund, right? So there are a lot of responsibilities that the general partners have, which is why they are very careful in terms of the investments that they are making, because they're not just investing their own money, they're investing money for other people, and the kind of return that they're able to give to their investors today is going to determine how much more money they can raise from these people and other people in the future, right? So pros, when we talk about it, usually there is a significant amount of investment that comes in through this channel, right? We understood in the previous module how VCs require a big exit. That also means that they're investing a lot more money. Two, they come in with a lot of expertise, since they are usually a lot of these VCs are sector specific or industry specific. So they understand one particular sector or one particular industry very well. And considering they have invested in a lot of these companies, they know what are the challenges, what are the hurdles that you're going to face. So they bring in a lot of expertise and a lot of resources again. Finally, if a VC does come in and invest in you, that is validation. That is validation for anyone who is wanting to invest in you in the future. This basically means that you have essentially reached a product market fit as a bare minimum for your company and your business model makes sense. The problem is that most of them will not commit at a very early stage. So don't waste time in pitching to them at an idea stage. They will not invest. It does not make sense for them. They might listen to you. They will keep you in the loop maybe for the future, but at the end you are going to most likely hear a no. Again, there's going to be a high dilution over here. Every round of VC money usually comes at about 20% dilution, and then maybe at a DEF kind of a round, the dilution becomes a little lower. Depends on the amount raised, obviously, but be prepared for high levels of dilution. Be also prepared to maybe start losing some control of your company in terms of board seats, in terms of exit preferences. A lot of them have exit preferences, right? The problem again is tough valuation, especially let's say for a pre-series or a series A round. Valuation becomes tougher because again the historic numbers are not as much, and they are also betting more on the team again at a very early stage. Later on it does come in at the revenue growth numbers, but there are three types of VCs. If you look at VC categories, right? There are micro VCs that invest typically 2 to 5 CR. There are mid category VCs that on an average invest 5 to 10 CR. And then there are bigger VCs that invest 50 to 500 CR kind of a range, or maybe more. So micro VCs are still taking bets on founders. As we move more towards mid and big VCs, they are betting on the businesses. Next, we've heard the term series A, B, C, D. Don't get confused. This is basically each round that a VC comes in. The first time a VC comes in, it's called a series A. The second time they come in, it's a series B. The third time they come in is a series D, so on and so forth. As I said, VC funding is validation. It's 90% out of your control now. The first time you take a VC funding, after that you get a team. As founders, you don't really need to worry too much about the next rounds of funding. It's usually the first round of VC funding, which is the biggest hurdle. But once you get that, you have team members who will tell you when to take more funding. You have your VCs teams, which will introduce you. If they're not investing more money, they're the ones who are going to introduce you to more investors. So most likely things are going to go a little out of your control now. You've officially entered the game. You will get to know when you need to raise more. You will get to know who you need to pitch, and that's how the game is going to get played now. As I said, once you start taking VC money, it's not just the initial pitch or the term sheet that you get, but after that, there is going to be a process of due diligence. Now, due diligence is where a lot of deals go through, a lot of deals do not go through. They do not go through because what the founders promised is not working. Since the time you started pitching to the time that the due diligence actually starts, your business could go down. You might not achieve the expected numbers, and the terms and conditions of the investment might change, even if they are not dropping completely, right? So due diligence again is a very important part. So even from day one, ensure that your books are clean. Don't try to take any kind of shortcuts. Ensure your taxes are paid. Your CA is making sure that your compliances are all done, and again, all of those things will matter. They will go through your bank statements, they will go through your compliance, they will go through your employees. They might talk to your key employees as well to understand whether what all you've actually pitched holds true or not, just to verify all of that. And anytime anything does not verify or is not exactly as you told them during the pitch, the term sheet could be withdrawn. So due diligence for VCs again becomes a very important part. As I said, VCs coming in is validation, and they will not come in before doing their complete homework, because again, they are responsible to other people for managing their money. All right, so that was majorly about taking investments from people who are going to take a part of your equity, who are going to take ownership in your company. Now we move to a part which I love, grants. Yes, there is a lot of competition, but if you are at a very early stage, this is probably your best alternative to any kind of external investments. Yes, it's going to take time, it's going to have a process, you'll have to apply, you'll have to meet people. There are different ways that you can, different places that give you grants and different ways in which they have their application processes, but this is basically free money, right? And who doesn't like free money? So grants are a great way to get your company through the gestation period. Before we move into the different kinds of grants, let's understand a few pros and cons of grants. One, they are non-dilutive. You're not giving out any kind of equity, right? So that's a great place to start. Two, there is lower financial risk because usually grants are not something that you got to pay back. There is no payback period for grants. And third, they're all unsecured. You don't need to give any kind of collateral or have any kind of credit history to get a grant. In terms of the cons, a lot of grants are specific sector oriented, right? Some could be impact oriented, some could be education oriented, some could be fintech oriented, some could be, it could be anything, right? But most of the grants come with a sector specific orientation. As I said too, it could be very competitive. In a country like India, a lot of people are looking to start up, and a lot of those people are competing for the same grants. So that is a problem. But there are a lot of international grants as well that you can apply for. Third, grants don't come with a lot of money. Yes, a little bit of money you might be able to get, but a lot of times these grants come in tranches, right? Which means that someone has promised you 10 lakh rupees of grants. It's not going to be that the entire 10 lakh rupee comes to you immediately. It's going to be probably 2 lakh rupees till you hit a certain milestone. Then you got to report back to them. Once you achieve the certain milestone, then they're going to release another 2 or 5 or whatever. But the problem is that the entire money does not come to you. This is not true for all the grants, but yes, there are a lot of grants that have this problem. So grants are again government or non-government subsidies that are non-repayable. Second is debt. A lot of new debt schemes have also been introduced for startups. There are loans that you could get from MSME loan providers at a low discount rate, low interest rate, let's say 5 to 7%, as compared to a 12, 13, 15% business loan that you might get from a bank, right? So startups have started getting a lot of loans. These are provided under government schemes, as I said. So again, the pro is that you are not diluting any kind of equity, you're not giving any kind of control over your company at this stage. And again, these are also unsecured, which means that these are available collateral free. The problem is, again, it could be sector specific since these come under schemes. Two, most of these loans do not come to you for validating your idea or creating your prototype or MVP. These loans come to you for scaling up once you have established some kind of early traction. So that's a problem. And again, there is not a lot of amount of money that is available. If you need 5 CR, you probably might not be able to get it through these kind of discounted loans immediately. So those were the ways that you could get money, grants and debt. Now let's come to the final topic for today's module, which is some kind of compliance that helps you get grants and other benefits as a startup. The first thing is a DPIIT registration. It's very easy. You can do this on your own. If not, you will be able to find someone like a CA, or there are other agents as well who help you out with this kind of a registration. This is a government regulation where you register your startup with the government. Again, as I said, it's very easy if you want to do it yourself. So I'd suggest you do it yourself. There are some benefits that you get out of this registration. One is you get a 3-year tax exemption. And it does not mean that these 3 years have to be the first 3 years of your company's life cycle. It could be any 3 consecutive years in the first 10 years of your company getting formed, right? So if you are smart enough, you might not take the tax exemption in the first year of your business because the revenues are not as much, you're burning money. Anyway, there's not a lot of tax liability, so you might as well pay it. But maybe in year 3, 4, 5, when your company is actually doing very good and you have to pay a lot of tax to the government, you can take these 3 years of tax exemption where you don't pay any tax. 2, to get access to any kind of government schemes or grants or any kind of access to all these, you need to be registered with DPIIT to be eligible for any kind of these programs. Third, your patent application or trademark registrations are fast-tracked if you are registered with DPIIT. And there are some other relaxations also, like labor laws, etc., do not apply to you for a certain period of time. So again, it's a no-brainer, right, for any kind of a company which is a startup to get registered with DPIIT. There is no cost to this. The conditions are that you must be a private limited, LLP, or a registered partnership. We've discussed this earlier. Your company should not be more than 10 years old. Your turnover should be less than 100 crores in any of the past 3 financial years. The business aim should be to innovate any kind of product or service or generate employment. I'm guessing you will fall under one of these 3 categories for sure. If you fall under all of them, then there's nothing better than that. Now, you might have heard of Startup India as well, and a lot of funding being deployed via Startup India. So Startup India basically gives you money in 2 ways. For idea stage companies, it gives a grant of up to 20 lakh rupees for prototyping, for creating your MVP, for validation. And it gives you a loan, which comes as a form of debt, interest free, of up to 50 lakh rupees that you can pay in, I think, 7 years. Now, everyone does not qualify for these. There are specific ways in which you get these funds. For one, you need to be a DPIIT registered startup. You cannot be more than 2 years old. You need to have a viable business model. There's an entire process to filing this, and I'll explain it to you how. 4, you need to have technology at the core of your product or distribution strategy. 5, you should not have received more than 10 lakh rupees in any other government scheme. And finally, the share of Indian promoters in the company has to be greater than 51%. That's basic eligibility. Now, they have a few preferred sectors. I'm not saying that people outside these sectors do not get investments, but they have 15 sectors where they predominantly prefer startups to be. So social impact, water management, education, financial inclusion, healthcare, defense, railways, textile, agriculture, waste management, food processing, biotechnology, energy, space, oil and gas. These are the preferred sectors as highlighted by Startup India. There's a role of incubators and accelerators. There are a lot of incubators, about 300 of them are registered with Startup India. These incubators have been operating for a minimum of 3 years, and they have been given the responsibility of distributing the funds via Startup India. So if you want to get the grants or the loan, you have to work with one of these incubators. You have your application on the Startup India portal. On the portal, you select up to 3 incubators that you want to apply to in an order of priority. What happens is that you give your preference to them, to the Startup India portal, and you submit your application. There are a list of questions that you have to answer and upload your pitch deck. Those incubators will invite, either they will reject your application or they will invite you to meet them. If they accept you, they will process the grant, although it does come in tranches over a period of time. If they don't accept your application, they will update it on the portal, and then your application will move to the second incubator that you applied to. This way, your application goes through at least 3 incubators, and you have a fair chance of getting the Startup India funding. If all 3 incubators reject your application, it could be that they do not like your idea, or it does not make sense, or at sometimes because there is limited amount of funding that each incubator can commit to. So they have enough competition. You have enough competition that you're competing against. So that also becomes a problem, which is why a lot of incubators might reject your application. A good hack to this process is speaking to the incubator before applying or wasting your application on this. The reason why I say wasting your application is because once your application is rejected by the 3 incubators that you applied to on the Startup India program, you can't apply for a period of 3 months. Yes, you can apply back after a period of 3 months with 3 different incubators or the same incubators while taking their feedback into account, but you still do miss out on the 3 months. So the better idea would be to network with these incubators, talk to them beforehand, understand whether they'd be interested in your startup. Once they give you a soft commitment is when you go ahead on the Startup India program and apply for this scheme. Most of these incubators also have some kind of preference. It could be a sector-based preference or a stage of a business preference. Incubators could have their own goals, needs, etc. as well. You're allowed to reapply, but only after 3 months of your application being rejected by the 3 incubators that you applied in the first go. These incubators have criteria on the basis of which they evaluate your startup. One is obviously the need for your product. 2, they understand whether there is actually a market gap and what about the existing competition in the market. 3rd, they understand the feasibility of your product, service, business model. 4th, they understand if you have any kind of novelty. Maybe you have created something proprietary, you have a patent filed, you have some trademarks, etc., or you have some IP. 5th, they understand the team that is working on this idea. So that again becomes a very important stage. Then they ask you for a fund utilization plan, like where exactly are these funds going to be deployed? As I said, the 20 lakh rupees that you get as the initial grant can only be used to better your product. It cannot be used for marketing activities. It cannot be used to pay salaries to your employees or to yourself. So there are stringent ways in which the funds have to be utilized, and you have to submit a plan in the way that you're going to use those funds. Every incubator has the option of setting up additional criteria. They have committees that work behind the scenes for this, and they do at times set up some additional criteria that they might want to put in. And finally, you do have to upload your pitch deck, and you have to go in front of them either physically or digitally to present yourself, to present your startup once they do invite you to pitch. Now that was basically about fundraising options that you have, the institutions, Startup India and DPIIT. Now we did divide our fundraising module into two parts. In this module, I just want to leave you with a little bit of understanding in terms of what investors are actually looking at. Since a lot of you do come to us with the hope that we'll help you, connect you to investors and raise money, and we have to politely decline, let me tell you what investors are looking for. These are some of the reasons why your investments get declined, because you fail to understand this. The first thing that you want to understand is what is the business model of an investor. The business model of an investor is usually not to build a company that is highly profit making. Their business model is to get into a company that can grow quickly. And I'll give you a valid reason behind this. Now imagine someone has invested 1 crore rupees into a business. That business reaches a 5 crore rupee turnover. That business makes, let's say, 10 to 15% net profit per year. What percentage of that is the investor getting? Probably not a lot. In fact, most of the business in the first few years don't make a lot of money. Right? So the investors are actually not making money, or making very limited money on their investment. They would rather invest that kind of a money in some other asset class. They make money when you blitz scale, when you grow, when your valuation increases 2x, 3x, 4x, 5x, 10x in a very short span of 2, 3, 4 years. Right? Their money actually grows 10x in 5 years, just because your revenue has increased without worrying about the profitability or the bottom line. So they are looking at exit options. In fact, you should understand exit options that your investors might look for in the future. And here are a few exit options ranked in a list, in a hierarchical order from top to bottom in what the investors prefer. First is a secondary sale. A secondary sale means that at a later stage of your investment round, someone else buys the equity of an early investor. So that's a secondary sale. Then there is the IPO, which is obviously something a lot of investors look for, but the chances of going to IPO for a lot of companies, it's not very high. Right? For a lot of venture-backed companies, despite being VC-backed, most of them do not reach IPO. IPO is an ideal case, but most companies still do not reach IPO. It's a good case scenario for everyone. Third is a merger, or fourth is an acquisition. Very similar. Merger means that you merge with another competitor or some other company working in the same industry. Acquisition would be, let's say, a bigger fish thinks that you have started eating up a part of their product line, a part of their market. You're capturing market share. Instead of changing their existing product, they acquire you because it's easier for them. You've already created some kind of branding in the market, and there is strong emotional connect with your users, and they're loyal to your brand. So it's easier for the competitor to buy you out. The next thing would be a buyback, wherein the company has made enough money that they buy back the shares from their existing users. And finally, a process that no one loves is liquidation, when the assets and other things of the company are sold off into the market. No one really makes a lot of money, but it's something that gives the investors a part of their money back in some scenarios. Okay, so now that you understand the different ways in which investors look for exits, there are going to be a lot of investors who ask you how are they going to make money. So don't be naive enough to immediately say that we are going to sell our company, because that actually positions you as not too committed. You have to convince them that you as a founder, which is not just something that you make up, but really believe that you want to be in the company for a long term, but at strategic points of the company's life cycle, you will provide enough opportunity for the investors who come in early to get their money back, to make money. It's how the ecosystem grows. You grow when they grow, and that is more likely for them to have enough confidence in you. You're smart enough that you are thinking about exit, not for yourself, but for the people who are putting in money. So why have investments dried up? Why have investments gone down? The simple reason is that a lot of IPOs have failed. A lot of companies have, a lot of professional investors, VCs, have lost money because companies could not pass on the buck to the retail investors. It's very simple, right? They keep adding money till the valuation grows. They reach an IPO stage where the buck is passed on to the retail investors. That's when the VCs recover their money. But considering these startups have not made enough revenue or have not made enough profits, retail investors have also lost money in these companies, and those VCs, the valuations at which that they expected the IPO to go to and for them to make the large exit, they have not been able to do that. So investments did dry up. Who is still getting invested? Companies which have proven in the past, founders who've proven in the past that they've made money, who've successfully returned money to investors, whether it's been acquisitions, mergers, or secondaries, or companies which are actually profit making. Today, with AI, there is not a lot of investment that tech startups need. Right? So initial investment requirements have gone down. People have started doing a lot of bootstrapping, and they've reached a level that they've reached traction and they've reached scale. A lot of them have also started making profits. These are the companies that investors are now going after. You see there's a flip in the script. So those are the types of companies that are still getting invested. Another topic that arises a lot of times, a lot of doubts people ask us is about conflict of interest. If an investor has invested in a company which is very similar to ours, should we approach them or not? Well, if you're not doing something very proprietary, I feel that conflict of interest is not a big problem. If you look at some of the top investors of both Swiggy and Zomato, you will find them to be the same. If you look at competing companies, you'll find that a lot of them have similar investors as well. This also because there are some investors who prefer investing in a particular industry. There are some who prefer investing in fintech. There are some who prefer investing in impact-based companies. So all of them are actually investing in the market, hoping that at least one out of the bets that they are making will capture the entire market, and they don't know which one of those bets is actually going to capture the entire market, right? So they bet on multiple companies, hoping that one of them will actually capture the market, and that will cover all their investments and in fact make them more money. Now, what you do in terms of your strategy is again based on your stage, your circumstances. Write down your doubts to us. We'll be happy to assist you with that. But I've given you enough context in terms of the options that you have. I still believe bootstrapping at an early stage is the best way to grow your company. It flips the script. it gives you more power, it gives you more advantage, it has the possibility of changing your life. But if you do feel that you have to go on the investment route, you have multiple options available to you. Send us your doubts, send us your circumstances, and we'll try to help you out with all of those things. If you need help with connecting you to investors, we have a venture studio model where we help companies go from idea to revenue, and in the meanwhile, we also help them to raise funding. If you're interested, do send in your applications through our website. We take only 5 companies every month who we actively help out in terms of all the support, and we look forward to seeing you in the next module. Thank you.